What if I told you some of the smartest investors in the world are pouring billions into power plants? Not tech startups, not office buildings, not crypto, actual assets that generate electricity. And they're doing it because these assets can produce stable cash flow, inflation protection, and long-term upside all at once. Today, we're breaking down one of the most important and underappreciated corners of alternative investing: power generation assets. Power plants sit inside what investors call real assets or infrastructure, and institutions love them for a few big reasons. First, predictable cash flow. Many power projects sell electricity under long-term contracts called power purchase agreements, or PPAs. These contracts can last 10, 15, even 25 years. That means steady revenue, often from utilities or large corporations. Second, inflation protection. A lot of these contracts include price escalators tied to inflation. So when prices go up, revenues can rise too. Third, massive global demand growth. We're electrifying everything: cars, homes, factories, and especially data centers powering AI. More electricity demand means more need for generation capacity. And finally, there's a capital gap. Traditional banks don't want to fund long-dated infrastructure like they used to. That's opened the door for private equity, infrastructure funds, and private credit to step in and earn attractive returns. Let's look at what investors are actually buying. Solar power. Utility-scale solar farms are now a core infrastructure investment. They have low operating costs, predictable output, and strong demand from corporations trying to lock in clean energy. Wind power. Onshore wind is another mature technology. It's scalable, often backed by long-term contracts, and already a major part of institutional renewable portfolios. Hydro assets are like the blue-chip stocks of renewable energy. Some dams have been operating for decades and can last a century. Very low marginal costs, very stable generation. Battery storage. This is one of the fastest growing areas. Batteries don't generate power, they store it. Investors make money by helping stabilize the grid, providing backup capacity, and buying power when it's cheap and selling when it's expensive. Hybrid projects. Now, we're seeing solar or wind paired with batteries. These hybrid plants are more flexible and can earn higher revenues by delivering power when the grid needs it most. Natural gas plants. Yes, even gas plants are still in demand. Flexible gas generation helps balance the grid when renewables aren't producing. These assets can benefit from capacity payments and power price spikes. Not all power assets are the same. Some are considered core infrastructure, like contracted solar or hydro, where investors target steady, bond-like returns. Others, like battery storage or merchant gas plants, are more value-add or opportunistic. They have more exposure to market prices, but also higher potential returns. So within one sector, you get a full spectrum: stable income, inflation linkage, and growth upside. This isn't just about ESG. This is about energy security, AI-driven electricity demand, and global industrial policy. Governments want more domestic power. Corporations want long-term clean energy contracts. And grids are under pressure from rising demand. That's why trillions of dollars are expected to flow into generation and storage over the next few decades. And alternative investors, infrastructure funds, private equity, and private credit are positioning themselves right in the middle of that wave. So when you hear about institutions buying solar farms, battery projects, or even gas peaker plants, just remember, they're not just buying energy. They're buying long-term contracted cash flow, inflation protection, and exposure to one of the biggest structural shifts in the global economy. If you want more breakdowns of how real assets and alternative investments actually work, subscribe. This is exactly what we cover here.